Hi and welcome to Penser Bank and our interview with Fingerprints regarding their Q3 results that were published this morning. My name is Markus Almerud. I'm an analyst here at the bank, and I have Christian Fredrikson, who's CEO at Fingerprints, with me. Hi, Christian.
Hello, Markus. Thank you, and good
Hi.
to be here.
Yeah, thank you for coming and talk to us. Let's start with the mobile phone market. It was a very dramatic report. The numbers are quite big, and the falls are dramatic. So let's try to dig into it a bit and go through the details of it and try to figure out what's going on and where we are. So if we start with I think the best way to do it is to go through the value chain in steps. And let's start with the consumer. So, where is consumption at the moment? What are consumers doing? And in terms of lockdowns, mobility figures show that Q2 was the trough in terms of lockdown. So, people are now moving again. So, what do you see on the consumer market and consumption in general? And
Yes,
with a focus on mobile phones, of course.
yes. Okay, so on the market in terms of mobile phones, we see roughly as with the analyst, anything around or below, just below 10% decline globally from last year in the mobile phone market, and that's the global situation. But of course, because of the lockdown, which was very dramatic, as we all know, in Q2 in China. And because they continue with the COVID, they call it now the dynamic zero. It's not zero COVID, but it's a dynamic zero COVID policy. In China, we probably see about a 20% drop from last year in terms of the mobile phone. And of course, it's been hit pretty hard in terms of Q2 then. So it has rebounded. The lockdowns are not of the same magnitude at all as it was in Q2, but they are still very strong. They have still strong lockdowns in China, and anything from 100 to 200 million people seem to be at any given time in a lockdown. So it's shorter lockdowns and it goes back and forth, but not the kind of full lockdown for 3 months as it was in Q2, right? So the biggest hit is, of course, in China and our Chinese customer base, and where we are, of course, so exposed in the China market.
So basically, in terms of volumes, we are above in terms of shipments of mobile phones compared to Q2. That is to the end consumer, but we're still significantly below where we were before.
Yes, exactly. And you can see the overall year is probably minus 20% in that ballpark for the China, roughly, right? That we see, which is it's of course a dramatic drop overall, not seen in mobile phone industry ever before, right? But still, I mean, but it's a big drop, but it's not 50% as all, which it was at the worst in Q2.
Okay. Because then we have the inventory effects that will come to that in a second on step by step. But if we move down the value chain then and talk about the OEMs, where are the OEMs? So is the destocking that they have gone through, is it done? And are they hence ordering from distributors again? And that is, are their orders matching real demand now? Are we at that stage?
Yes, I think the OEMs are now there, right? So they've been depleting, and because of the supply challenges that we had before, right? Before the COVID lockdown, the whole world had been in terms of chips and supply. Had been supply limited for 2.5 years, right? So basically, I think they and many parts of the ecosystem had overbuilt inventory wherever they could, right? So we went in 24 hours from a supply limited to a demand limited situation, and now they have depleted there to normal levels, and actually they have gone and now continue to go below normal levels even. So there's an extra cautiousness that is there. So the inventories are depleted more than what you would deplete them in, even looking at the volumes. So yes, now of course they are, and the orders have started to come again through the chain now, because it is getting pretty empty in the inventory if I look at that way.
And if I look at distributors and module houses as kind of the next step in the value chain, if I understand things right, they have just started to emptying their inventories. So I assume that that means that they're also then not buying anything from you. Basically, it's basically zero,
Well,
more or
it's
less.
not zero, but it's been very low. And Q3, of course, was a dramatic effect, as you can see in our number. It was a very tough
Mhm.
quarter for us. And at the same time, we had been building inventory through Q2 and Q3 because we have ordered equipment 6 months ahead. So even if we
Mhm.
stopped ordering in early April, it still comes in for another 6 months for us. And you can see that for our part. But yes, I think the distributors and the module houses have been depleting their inventory in Q3, and they continue depleting that in Q4.
Mhm.
But we have already now orders happening for us, and you could see that some of it, of course, happened for us in Q3 as well. So, and we will start to deplete our inventory and have started to deplete them now in Q4. So now our inventories are going down.
So the reason basically for Q2 being so much higher than Q3, despite the market in, I mean, standing more or less still, is the lag effect that you're talking about. That the different parts of the value chain didn't pull the brakes until maybe later when they saw what was happening, and then there's a lag effect because there are still orders in the system, and that's why we're hit so hard now. Is that
Exactly.
the right kind of
Exactly.
conclusion?
That's correct. And that's how this, and I suppose it's the first time the whole ecosystem has been hit like this. I have never seen this before of this magnitude. And of course, so much on the Chinese ecosystem where we are, of course, so exposed. So this really hit very hard in that ecosystem, and it's across all of our players. And we are probably the one with the least of inventory buildup if I look at all our competitors and everybody. So if I look at percentage-wise, we are clearly the one with least inventory, and we have already tied in 200 million SEK, around 200 million SEK of excess capacity in our inventory. So
Hmm.
of course, from our part, we are buying very little now in Q4, but we are now depleting our inventory. So of course, from a cash flow, it turns the other way around now.
And I guess this means also that if, I mean, when you start, the only way for you to deplete your inventory is for the distributors and module houses starting to buy from you, so that they are able to. I mean, that you're starting to deplete your inventories now mean that they are buying more than before. Is that again
Exactly.
the right conclusion?
Exactly. So now the purchase orders from our point of view are moving again. And what we have done during this one is, of course, what you do is you stop buying immediately, which we did very early on, actually early April already, when, just a few days in, we realized that this could get pretty bad, but not even we realized how big the lockdown would be, right? And how it still continues, even if it is a smaller way. And then the two other things we have done is continued to be very fast and moving in keeping our market share and improving our market share in mobile, so that when it moves, we are in a good position, and that we have maintained and improved on. And then some continue hard on the diversification into the new areas, right? To
Hmm.
limit our exposure. Of course, this has kind of shown clearly our exposure to the Chinese market and the mobile market.
Hmm. So so if I read you right, and if I put all that together, it still it seems like, I mean, you had a big hit now in Q3. I mean, Q2 was really bad, and then you had, or Q2 was bad, and then you had even worse numbers in Q3. But now that they're starting to buy again, does that it sounds like Q3 was the worst quarter, and then it should start to look better from now on.
Yeah, we don't give any guidance now because there is so much uncertainty, right? But this should, of course, I do believe that the worst is over for us in this whole depletion and the inventory buildup. Yes, and then we can work out from here. I think that there's still a couple tough quarters when it comes to
Hmm.
this, all of this, to kind of find the balance against in the system. And then, of course, we have to continue to improve our market share and build on the new diversifying areas. Yes. So That's how it brings for us. And I think that if we have assumed, if I look at the assumptions, we assume that the dynamic zero COVID policy will continue in China. We have assumed that for next year as well. So it's kind of positive if that would open up in some ways, but we don't assume a full lockdown like in Q2 either here, right? So it's a bit depends on what they do in China. Nobody really knows, or at least we don't know here in the Western world, I assume, right? And we will see how that goes. But we assume now that this dynamic zero COVID policy continues, where they are going into lockdowns, they are faster, and they keep on testing and putting people in tracing and putting them in lockdown if there is some spreads.
But is it fair to say that, and I know you don't give details about this, so it's just a general question, but I mean, if I try to get a sense of how much what sales in this segment was in the quarter, it's quite a low share of the total sales, meaning that even if it would fall sequentially, the effect would not be as dramatic because it's quite a small part isolated in this quarter.
Yes, and of course there was now also some mobile sales, right, that we have gotten going and so. But I think the good thing is for us is that we are getting all the 3 new legs for us are coming in, right, and so that gives us even if mobile capacity with everything going on is not bouncing back to the same it was last year, for example, but we still have new businesses coming in, right? So that helps us a lot actually when we go forward here. Yeah.
Okay.
Yeah.
Moving on to PC and talk a little bit about that. So that's one of the bright spots. It's growing, and you also published updated figures in the presentation, indicating a penetration of 26% this year, going to around 33 to 34% in 2025, and that might be a bit slower than some people would expect. So if I dig into this a little bit, do you also expect market share gains here? That is, if I put the question a bit different, how much of this 26% is the kind of advanced sensors that you're in, or will the way that the split within the 26% also change, so to speak?
I think that yes, you're right. It's growth from 26 to about 33%. The biometric penetration rate within PC and the biometric market is growing within the PC market. Despite the PC market, we expect around a 15% decline in the PC market versus last year. So the PC market overall is declining, but still the biometric market is growing, and we expect to continue to win market share and grow within that biometric market, right, from our numbers, right? So for us, this is a growth area clearly because of that, right? So penetration rate grows, and of course our market share grows within that. We have gotten now 4 out of the 6 main PC manufacturers in the world are now our customers, right? And when it comes to the different products in that area, we have earlier had the match on host, which is about half of the market. Now we have just launched as well the match on chip with the first PC from us, which is the other half of the market, the kind of high-end enterprise market. So now we have actually a full portfolio for the whole biometric market in the PC market as well, right, going forward in the next year.
Yeah, and the figures that you have in your presentation, which talks about 26 penetration now, going to over 30% in 2025. That's the whole market, or is it just the consumer market?
That's the whole market, yeah.
That's the whole market, yeah. Okay, let's move down the P&L a bit. Let's talk about the gross margins. So they were also down sharply on the back of the lower sales. So it's difficult to me. You have a cost base that is fixed. So it's difficult to, it's difficult that you don't get this kind of movement when sales fall the way it did this quarter. But can you elaborate a little bit on the drivers behind the gross margin fall?
Yeah, I think it's one is of course the just big drop in sales. So then we have fixed cost, and even if we have cut cost, which is coming into effect in Q4, uh, that cost was still there in Q3. And on top of that, we have project amortizations that we are doing, or depreciations that we are doing in every quarter, and that amount is also fixed, right? So if you look at that, you probably have, just because of the depreciations of our older R&D projects, which are going as a fixed cost, it's probably about 10 percentage points single-handed drop because of that, because of basically the volume drop. So the volume drop really, it shows that we are very scalable business when it goes, when we are a little bit higher sales volumes. But when you go to these kind of volumes, which was very tough for us, a tough quarter, then you can see how, it hits the gross margin, and it gives a bit skewed view actually from that perspective. So there is almost, but just because of that, the 10 percentage point drop because of the fixed cost hitting the numbers in a different way, and that affects the gross margin, right? It's of course a correct gross margin, the 12%, but of course with this sales volume, it just hits you hard.
Yeah.
And that's one. And then the other thing is, of course, that we have had a lot of access business that was still, especially now in the Chinese market, the access business has been based on a lot of the door lock business, which is for us the construction business in China. And that has, obviously, with the lockdown, the construction business is not doing well in China at all. And on top of that, even in many of the houses and where it is, so it takes a little while now to get the door lock market going as well, because people are not, they are afraid to take people to their home to even put the door locks into place, right? So people are so worried about the spread of the virus that there is an extra cautiousness in how so they have to build new processes and new ways of doing it, right? So that's why it's a bit tough as well for a while.
So it's not just the construction market per se, it is also the COVID effect and lockdown effect that you don't want people around in your house. It's a combination of those.
Exactly, and that's kind of a natural kind of fear of being cautious of having any unknown people around to even install stuff for you. And they are, of course, they are fixing this in terms of processes. How do you do it, and how do you protect everybody in that, so that nobody has that fear in it. But of course, it's also takes a while to fix those. I think that impacted the access business quite strongly for us in the China market, which has been the biggest portion of the access business. Rest of the world access business is growing for us quite well, actually, and that continues to happen. There is, of course, these impacts are not seen in the access business in the rest of the world, actually.
Yeah, yeah. And now we haven't touched. Oh, before I ask that, so there's also an element you mentioned, price erosion, which is natural where we are in the market we are. And I know that you don't usually talk about levels and such, but can you give us some color on the price erosion in terms of levels or magnitude or anything that we can?
I think there is, now we don't really want to give that, but there is, of course, a substantial, when there is a lot of excess inventory and people have bought it with, and at the same time, all the supply chain is going to a situation where there's demand limited, so prices fall all the way into the chip side, right? Which is the first time in almost 3 years when it's affecting also the chip, the wafer industry, right? And that means that basically what you have bought in this whole chain is more expensive than what you can buy in now. So of course it leads to a fact that everybody just wants, that is what happens traditionally, and this is of course unseen, the effects here now. So basically people are just cleaning inventory to get the old stuff that they have bought, get them out. So then of course there is a little bit of or not a little bit, but clearly more aggressive price movements there for until you clean the inventory and you get all the new equipment going again. And I think that's kind of market economy, the way it works, just right.
And then when we're out of this, should we expect to stay at this level, or is it possible that it'll bounce back, or do we have to wait for new versions to come out to kind of stabilize the price level again, or how should we think about that?
I think all the new areas for us where we are diversifying outside of mobile, it's not at all the same impact in those areas, right? Because there's not this inventory buildup in the same way at all, right? But in the mobile, we are of course coming into optical as well. I think in the mobile we will have a tougher quarters in Q4 and Q1 as well, still in the mobile when it comes to for us and for everybody around us to empty their inventories. And I think that, of course, then the gross margins will start to improve, and with new products and also new supply coming in cheaper, you will actually be able to do that. And then over time, it's going to get much better again. And I think also this is a bit of a dropout game. That's why we have gone in and we have gained market share in this one, because of course there will be players dropping out as well during this process.
And then finally, maybe on inventory levels, because the inventories are quite high, and is part of the reason why you do a capital raise as well. So you talked about 200 million of extra inventory, and it's basically the levels that we've seen it come up from, I think 160, 170 to over 400 million from the end of last year. And you're starting to deplete those inventories now. How long do you think it'll take to normalize? Are we talking 2 quarters, 4 quarters, 6 quarters?
It's not 4 quarters and 6 quarters, but it's 2 plus, maybe something like that. Q4 and Q1, and then a little bit maybe more than that. Depends a bit on the product mix as well. And I think that at the same time we are building inventory in the new growth areas where we are diversifying, right? So we need to do that as well. I think something in the excess of 200 million SEK is a normal. 200 million SEK is a little bit over that. This would be a normal inventory situation for us, right? And now we're over 400, so clearly that needs to come down to half of it, right? And you're right that this, of course, led to why we had 70 million SEK in cash at the end of the quarter, and we had put 200 million SEK in excess capacity, right, which we need to now deplete. That's where, of course, you see the reason for all the going to the financing market right here, which I'm very pleased that got such a strong response actually, and oversubscribed 2.5 times actually. So I think that's a great sign of confidence as well in this one.
And you said, right, that we should get to hear more about the terms, etc., at the end of the month, just before the extra AGM.
Exactly, the board will communicate about that one, of course, and I think the date now was 31st of October is the plan when the board will come out.
Okay. All right, and now we haven't touched upon payments at all, but it seems to be going according to plan. You were talking about two new launches in Q4, or at least we should be at 12 at the end of the year. So it seems to be progressing in line with the plan.
Yes, banking now is the first year when it's progressing according to the plan, I would say. I mean, it's still low volumes from our perspective, but it is in the hundreds of thousands, right? And cards going out there, and we're going to be at 12 banks launched, and we see a lot of activity and interest now with banks in more in Middle East, in Africa, in Latin America, outside of Mexico, where we have launched, and then also in Europe now, and specifically also in France actually. So the effect is coming. So I think that is clearly moving now. So more banks coming. Of course, we need to get to a place where it is not an opt-in, and where there's two things clearly. Opt-in, where you have to choose as a consumer, do you want it, which means you have to know about it and you have to go. And then the second point is that you have to go to the branch in most of the cases, to banking branch to enroll. So we clearly need to get to home enrollment and not an opt-in, but rather that you get the card with the biometric sensor, right? And we see the first banks now specifically launching it with that way actually.
All right. Well, if I try to sum up a little bit, so it seems, I mean, it was an extremely tough quarter, and we should expect a couple of more difficult quarters ahead. But that said, this should have been, I mean, all else equal, that this should have been the trough and the most difficult quarter, and it should start to look at least a little bit better progressively going forward. And that should also help the gross margins a bit. And then you start to deplete your inventories now. So we should see a bit of a positive cash flow effect. But then over the next 6 to 9 months, we should see normalization of working capital, basically.
Exactly. And of course, we will now, our focus is, of course, not only depleting inventory, but one, we are going to continue to gain market share in the mobile. And then second, we're going to strong out now diversifying in the new areas where we have built in a great channel, both in PC, in the access, also outside of China, actually, which is growing. And then, of course, payment area. That's exactly what we're going to drive now.
Perfect. Thank you very much for coming here and talking to us.
Thank you very much, Markus, and thanks, and great to be here again.
Thanks. Bye.
Bye now.